which you mentioned, energy generation, industrial production, deindustrialization. You can't understand, and they're all big topics. You can't understand any of them separately from the Green New scam, and financial warfare and a lot else going on the political side.
And I know we can dig a lot deeper, but we don't have the time. But it's kind of like war and investing. It's an awful topic, war, but it's a fact. And you just mentioned the war in Gaza. We've got all these little arguments, and China potentially imploding at the moment as well.
Right.
There seems a lot of confusion from investors. It's almost like they want to sort of sit on the sidelines because there's so much confusion and there's so much disruption in the world. How are you seeing it, Jim?
Well, that's right. And, look at the US stock market, which I don't know why I bother looking at the ticker. It only goes up. So I don't know. I got checking. Oh, it's up. Oh, what a surprise. It only seems to go up. It's at all-time highs. People say you can't spot a bubble, and I completely disagree. I don't think there's anything easier than spotting a bubble. The hard part is knowing when it'll burst.
Yeah.
Because bubbles run on narratives. They run on stories. And as long as people believe the story, it'll keep going. Whether the fundamentals are there, doesn't matter. They just believe the narrative. And right now, at least in the US, the narrative, and I emphasize the word narrative because it's just a fairy tale, is the soft landing. Yeah, we had a 3-year bad patch with the pandemic, and then the supply chain disruption, a couple of wars, and then very high inflation in 2022. So from 2020 to 2023, really, we had to get through all that. But now, thanks to the genius of Jay Powell and his interest rate policy, they call it the Goldilocks theory. Not too strong, not too weak, just right.
Right.
And then soft landing is the other. That we had a bad patch, but we're coming in for a soft landing. All nonsense. There's no such thing as a soft landing. If an array of indicators that have a very good track record over decades or longer of indicating a recession are all pointing in the same direction. They're all saying, yeah, the recession's coming. May not be here yet, but I'm talking about inverted yield curves in the treasury market, inverted SOFR curves. SOFR is a system overnight financing rate. That's the new LIBOR, if you want to think of it that way. They trade on the CME Group futures. But negative swap spreads. Some of these things are a little technical, but just to take an inverted yield curve, a very simple example. A normal yield curve, it's along the x-axis you have the maturity, and along the y-axis you have the interest rate, and it goes up from left to right. It kind of slopes up gently, and all it says is that longer maturities have higher interest rates. So if I lend to you for a month, I might charge a certain interest rate, but if I'm going to buy your 5-year bond or your 10-year bond, I'm going to want a higher interest rate because there's more risk, more things can happen, credit risk, inflation risk, political risk, et cetera. Well, that's the normal state of affairs. That is not what we see today. What we see is called an inverted yield curve, where as you go out the maturity curve, the interest rates go down. Right now, today, the 3-month bill, which is, I think, is one of the shortest maturity U.S. Treasury bills, is about 5.1%, a little higher. And the 5-year note and the 10-year note are around 4.1%. So why would you take, I'll use round numbers, why would you take 4% on a 10-year note when you can get 5% on a 1-month note? What's up with that? Well, what that's telling you is telling you something. It's very powerful.
Okay.
Because this market is the big money. When you talk about U.S. Treasury market and but basically Eurodollar futures, they call them SOFR. It's a really clunky name, but they're basically the Eurodollar futures. This is the big money. These are banks, hedge funds, sovereign wealth funds, the largest pools of capital in the world, and therefore, in theory, the most sophisticated investors. When they're betting that interest rates are going to drop 6 months and a year from now, what they're saying is there's going to be a recession. In other words,
wow,
if I take 4% on a 5-year note, and I could get 5% on a 1-month note, am I a chump for taking 4% on a 5-year note? Well, yeah, I mean, I can get more on a 1-month note, but if 5-year note rates drop to 2%, I'm going to look like a hero. If
Yeah.
I'm getting in my example, 4%, and these are the actual numbers, if I'm getting a 4% yield to maturity in a world where the 5-year note drops to 2%, first of all, I'm going to have a huge capital gain because, bond math 101, if rates go down, prices go up. So if rates drop from 4 to 2, I'm going to have a big capital gain on that 5-year note. Or I can just sit there and collect 4% coupons in a world of 2% interest rates. I look like a hero either way. So investors are saying, yeah, I'm going to make that bet. And they are. That's what the market tells us. You would only do that if you thought interest rates were going to drop a lot. And why are interest rates going to drop? Because we're going to have a recession. So this is this is the opposite of the narrative. The narrative is the Fed did everything right. There's no inflation, good growth, buy stocks, buy stocks. The reality is, no, we're heading for a recession. Inverted yield curves tell us that. By the way, we don't really have time to get into the technicals of negative swap spreads, but a negative swap spread says, I'll take a lower fixed leg on a 10-year swap from a bank or hedge fund than I could get from the treasury. I could buy a 10-year treasury note that would pay me a certain amount, but I'll do a swap with you, a 10-year swap off balance sheet with you, and I pay you floating, which is like a financing rate, and you pay me fixed. Normally, the rate I want from you, I insist on a fixed rate from you that's higher than the treasury rate because I have credit risk. I'm not worried about the treasury, but I got to bet on you. But in fact, swaps are and that's called the swap spread, the difference between the treasury note and the comparable maturity counterparty fixed rate. Why would you take a lower rate from the counterparty than you could get on the treasury note, considering the credit risk in the counterparty? The answer is, well, there are two answers. Number one, it's off balance sheet. So it tells you the bank's balance sheets are constrained. You can't, they don't have room for putting treasury notes, but you can always do a swap because it's off balance sheet. But the other thing it tells you is that there's a shortage of collateral, a shortage of high quality collateral. So, but these are signs, but those are bad things. When bank balance sheets are constrained, when there's a shortage of collateral, which means you can't keep leveraging up because you have to post collateral to support the position, but there's a shortage of collateral. So so the dealers are in a position to pay less. I'm going to pay as a dealer, I'm going to pay you less than you can get on the treasury because you're desperate to do the swap with me. So, so for those reasons that we have negative swaps, but again, that's highly unusual. It does happen, but it's highly unusual and it's a very bad sign. So the markets are littered with these really technical but negative signs that correlate very well with recession, but you don't hear about it. Nobody's talking about it on financial TV.
No.
Correct. Right. They're talking about Goldilocks and soft landings, and how central bankers are geniuses and they've done everything right. But it's very troubling, and you're starting to see cracks in the facade. Certainly in the U.S. commercial real estate, it's in that pretend stage where everyone knows it's worth less, but nobody wants to engage in a fire sale. Nobody wants to write it down. We had
but sorry to interrupt you, Jim. That's just commercial, isn't it? I think residential's fine because there's a movement from commercial to residential.
Correct. And in 2007, it was the subprime mortgages and the all-day and the mortgage and the home mortgages, et cetera. That was where the stress emerged in a huge way. But it's never the same twice. But now it's not. You're right. It's not in single family housing or even in a lot of multifamily housing. It's in office buildings and industrial parks and other commercial real estate ventures. So that's in the pretend stage right now. Like, oh, just don't mark the boat, roll over the loan, don't market the market. Yeah, exactly. But it's starting to break. We saw this New York commercial bank, NYCB. I don't know if it might have been like New York Community Bank, but whatever. But it was a medium-sized bank, about 100 a million of assets, which is not huge, but decent size. But it had two big commercial real estate write-offs about 10 days ago. The stock crashed. They're trying to prop up confidence, and now the stock's going down more. That bank may fail. I'm not predicting it will fail, but it certainly has that kind of dynamic. But that almost looks like stage two
Mm.
of the banking crisis. It started last March with Silicon Valley, Signature Bank, Silvergate Bank, which is different than Silicon Valley, and First Republic and Credit Suisse. Credit Suisse is one of the biggest, oldest banks in the world, and they all failed in a 2-month period between March and May. But then it got quiet. Everyone said, "Oh, the crisis is over." But the history of those kinds of financial crises is that they often have like a halftime where things do calm down, and then it
Yep.
comes back with a vengeance. We saw that in 1998 and other occasions. So these are all things to be concerned about. So I guess as an investor, I would say, I'm not saying don't buy stocks. I mean, I think the defense sector could do okay. I think the energy sector, meaning
Mhm.
Chevron, ExxonMobil,
The
the
big oil.
oil and natural gas giants. Perhaps the uranium sector. I follow it, but I'm not expert on it. So look at some names there. Agricultural. We got to
Yeah,
eat.
everyone needs to eat.
Yeah, and then the defense sector because of all these wars. So there are sectors, and mining also. So there are sectors that, in my view, will do well. But I think tech is clearly a bubble. I just finished writing a new book. It won't be out until later this year, but it's on artificial intelligence. And I've spent,
Oh my goodness. Oh my goodness.
months and
What's that
months.
called? Oh, that is such a topic.
Yeah, when we get, it'll probably, well, actually, we have a publication date. It won't be till next November. Just
Yeah.
the book publishing industry works on its own tempo, and that's just how long it takes to get a book out. But and we'll talk more about it this summer. But it artificial intelligence, I would say, yeah, it's powerful, it's a big deal,
Mm.
it's real, but there's a lot less there than meets the eye. And again, it kind of has those, and GPT is sort of I call it a speed reading plagiarist, but it's a bit of a novelty, a gimmick kind of thing.
Yeah.
They're not really intelligent, it's just math. But I think there's a lot less there. Powerful, important, yes, but less there than meets the eye. So I think some of those stocks are headed for a fall. So I would lighten up on equities, except for the sectors I mentioned. I would increase my allocation to cash. Always have 10% in gold. If you have 10% in gold, sit tight. If you don't, get up to 10% because that will serve you well. And there are some alternatives, and there are, if you're selective, there are some good, in the venture capital world, it's harder to access. And you have to be really, really careful in your due diligence, but there are some opportunities there. But yeah, I would definitely lighten up on equities. Too soon to get into commercial real estate. Give it a year or two. There'll be some bargains, but not yet. But I would mainly increase allocations to cash because it'll see you through, and then you'll be able to go shopping for bargains when the time comes.
I love that. Jim, one last question before you go. You correctly predicted that Trump would get into the White House in the past. We have an election coming up. It would be remiss of me not to say, Jim Rickards, got a view? It's a bit chaotic.
Well, anyone who does any political analysis, and I have for a long time, knows that, I don't like cliches, but some of them work. And one of them is that a week is a lifetime in politics. And that's true. It's a cliche, but it's true. So you don't want to put any stakes in the ground. A lot can happen. But right now, on form, as they say at the racetrack, I would see Trump not only winning, but it may be an electoral college landslide. Now,
Wow.
we have a funny system. Everyone counts the popular vote. Trump will probably lose the popular vote, but it doesn't matter. That's not how we elect presidents in the US. And California, California is a good example. California will deliver 6 million more votes for the Democrats than the Republicans. That's just a fact. But you can only win it once. You don't get to win in California 6 times. So those 6 million votes you might as well flush them into the Pacific Ocean. They give the Democrat an edge in the nationwide popular vote.
Yeah.
But it doesn't matter for two reasons. Number one, that's not how we elect presidents. And number two, it's state by state, and you can only win California once, and the Democrats will. But looking at the other swing states, And by the way, we have 50 states, 40 of them, I can tell you what's going to happen with almost certainty. So you don't have to spend any time thinking about them. Alabama will go for Trump. California will go for Biden. Mississippi will go for Trump. New York will go for Biden. Those are the easy ones. So you get down to 10 states that will decide the election. And we know who they are. It's Arizona, Georgia, Michigan, Pennsylvania, Wisconsin, North Carolina, maybe little New Hampshire where I live. We only have 4 electoral votes, but we are an honest to goodness swing state. And Nevada. I don't know if I'm up to 10 yet, but that's kind of it. Trump's leading in the polls in all of them. And he's getting a lot of Black men in particular. The Black vote is reliably 90 to 95% Democrat, just like clockwork. But after 50 years of no economic progress, the African Americans are starting to stand up and say, wait a second, why are we voting for the same people and we get nothing out of it? They're taking a close look at Trump. But here's the point. African Americans are 12% of the vote. If you just get a 10% swing, so the vote for the Republicans goes from 5% to 15%. I'm not talking about 30 or 40 or 50. I'm just talking about a 10-point swing. Well, 10% of 12% is 1.2%. The last 4 elections have been decided by less than 1%.
Wow.
In other words, that vote by itself is enough to tip it to the Republicans. The Arabs are, it's like any ethnicity, the Irish or the Italians or the Jews or the Arabs, they tend to congregate in certain cities because they have a mini culture. The Arabs are heavily concentrated in Detroit, which is the key to the vote in Michigan, which is an important state. Arabs are not going to vote for Trump, but they might stay home because they're very dissatisfied with Biden's support for Israel. So when you get into this is how you do electoral analysis. When you say, okay, well, the Arabs in Michigan are going to stay home. They're not going to vote for Trump. They're going to stay home. And African-American men in particular are going to lean to Trump. Hispanics, same thing, big swing in favor of the Republicans. You could get into a situation where Trump could win all of those states, or almost all of them. And even though he could lose the popular vote or maybe kind of come 50%, it would be an electoral college landslide, meaning 320 electoral votes. You only need 270 to win.
Are they going to try and stop him though, Jim, by some sort of a not impeachment? He's not president at the moment, but are they going to try and stop him?
Kerry, Greg, what else can they do? He had the Russia hoax, which paralyzed him for 3 years, 2 impeachments on nothing. One was a phone call. One, he was out of office. 95 felony indictments, 4 criminal trials in 4 parts of the country, $83 million judgment in a defamation suit that's dubious, and a civil judge in the Bronx who's going to rescind his business license, put his properties into receivership, sell them off, and you're like, oh, well, won't Trump get the money? Well, the answer is no, because they're going to throw a $300 million fine on top of the rescission. So, I mean, seriously. And then they want to keep him off the ballot under the 14th Amendment, Section 3. Right. The Supreme Court heard that case today, by the way, oral arguments in the case. So I hear you. You're right. They're going to try to do everything they can, but they're sort of running out of things to do. I've never seen more stuff: legal, civil, criminal, political, media thrown at one man. And he's still standing. In fact, he thrives on it. The polls are interesting. Every time he gets indicted, his popularity goes up.
Really?
So,
wow.
Yeah, that's very clear. So it'll be interesting. So again, things can change. Keep an eye on RFK Jr.'s third party. That's the other thing that'll beat Biden are the third parties. Usually they get 1 or 2% of the vote. This year it could be like 1992 or 1968, where they get 15% of the vote. I mean, that would crush Biden because it mostly comes from the Democrats. People forget 1968, it was Hubert Humphrey versus Richard Nixon. George Wallace won 5 states. He was the segregationist candidate, but he actually won 5 states. In 1992, Ross Perot got 19%, didn't win any states, but probably tipped the election to Bill Clinton. So this on top of everything else we mentioned, this will be a big year for keep an eye on Cornell West, Jill Stein, RFK Jr.,
Yeah.
and maybe Joe Manchin jumps in on the no labels party. So it could be pretty wild in terms of third parties.
Going to be a wild year in 2024. Final comments to go to you as we wrap this up, Jim. For investors out there that are watching this, you said before 10% in gold. Make sure you've got some cash. You're a little bit worried that it's a bit bubbly, but mainly in the tech, not the commodity sector.
Yeah, that's right. And the thing about cash is it's the opposite of leverage. I mean, leverage increases the volatility, but you hope you bet correctly and you make a lot more money, but you can lose a lot more money.
Yep.
Cash is the opposite. You won't lose money in cash, and you got to watch out for inflation, but that's why you have the gold. That's why you have the gold.
There you go.
And right. And again, you can sleep at night, and people say it has a low yield. Actually, some CDs you can get 3-4% these days.
Yeah.
But the main reason to have it is it'll reduce the volatility and gets you through an extremely volatile period. There's so much uncertainty. You can say there always is. There's more now than usual, including, will Biden even be the nominee? I mean, he thinks he's talking to Mitt Romney and Helmut Kohl. Maybe not. So stay, we'll see how it plays out.
Jim Rickards, as always, an absolute pleasure to talk to you and to our subscribers. We really appreciate your time, and we'll see you hopefully once again on the channel in the near future, perhaps when that book's coming out on AI. But for now, thanks so much for joining me.
Thanks. American shipping has been hit, and the Red Sea is closed, and by extension, the Suez Canal is closed, and now your oil from the Middle East to Europe or natural gas for that matter, has to go around Cape of Good Hope. I've been there. It's a pretty place, but it's pretty far from the Red Sea. So what does that do just financially? Well, it adds a lot to your transportation costs, which means that will put upward pressure on the price of oil. I mean, we are in the dollar and U.S. in particular are in a serious disinflationary mode. Maybe dangerously close to deflation, which is worse, or at least harder to get out of, and creates a lot of difficulties for debtors. And then the debtors default, and the loss goes to the banks, and the banks start to fail. So you have the makings of a recession and possibly a bank panic. Well, now but the one thing that is going up, other than gold, is the price of oil. Well, that's because of the geopolitical tensions we're describing, but those transportation costs are going to go up a lot. Insurance costs are going to go up. That's going to go cut against what the Fed's trying to do, which is to get disinflation. It's going to cut against whatever otherwise disinflationary trends. That means the Fed will not cut interest rates. As Wall Street's been wrong about the pivot for 2 years, it's sort of become a running joke. I mean, they started the pivot dialogue in the summer of 2022, so not quite 2 years. We're still a few months away, but if you're wrong for 2 years, maybe you'll be right eventually. But Wall Street's been completely wrong about the pivot, and we'll see what the Fed says, in this current meeting. But the idea that the Fed's not going to cut anytime soon because the price of oil is going up, and that hasn't even filtered through. It's only in the past month prices up 15%. That's at the wholesale level. But I mean, the near month futures contract, West Texas Intermediate on the NYMEX, but that hasn't even filtered through to the gas at the pump, transportation costs for food, clothing, and everything else we do. But it will with a lag. So the headline CPI is going to remain high for at least the next several months, even in a world that wants to deflate. So. Thank you, Hooties. You're messing up the Fed, but again, it goes back to what I said earlier about how this is all connected. Now the question is, what is the United States going to do about the dead U.S. servicemen and women, and will that involve an attack on Iran? I don't know. A lot of people are calling for that. We'll see, but it fits this escalatory dynamic where it's Hamas, Israel, Houthis, United States, Hezbollah, Iran, and recently Iran attacked Pakistan. I mean, did they not know that? Do they not know that Pakistan is a nuclear power? Israel's a nuclear power. Russia's on the sidelines. They're a nuclear power. I was just in Dubai recently. The Dwight Eisenhower aircraft carrier battle group. I didn't see it, but it was in a tall building. I was looking for them, but they were right offshore. They were out there in the Straits of Hormuz. I was pretty close to that area. Well, I was in that area in Dubai, and there are plenty of nuclear uh, armaments in that battle group. Those aircraft carriers don't travel alone. They go with destroyers and cruisers and submarines, and there's a separate nuclear armed submarine in the area as well. In the most recently in the Red Sea. I'm not sure exactly where it is right now, but it's somewhere in the area. So between Israel, Pakistan, Russia, and the United States, you're surrounded by nuclear powers. The UK is involved as well, and then Iran is probably just weeks away from being able to test their first nuclear weapon. And yet here we are, we, the United States and Great Britain, in an escalatory dynamic with Iran. Um, I'm not saying there shouldn't be some response to the killing of American service people. What I am saying is, where was your diplomacy? Where was your ability to think two moves ahead? 4 months ago, why are you in this situation? Why do you not? Why did you not foresee it and think about ways to de-escalate rather than escalate? And the answer is they're not that smart and they're not that talented. Meaning the United States.
Fascinating discussion. So before we talk about the economy, we have to talk about China. It's the second largest economy in the world, so it warrants a discussion. And even though one never really knows what's happening in China, the narrative right now is that the real estate market is imploding. And just recently, Evergrande, China's largest property developer, was forced into bankruptcy. But what are your thoughts on China and its impact on the global economy?
Well, I mean, the impact is huge, but China is imploding. I mean, Evergrande, yeah, they technically filed for bankruptcy, but they were bankrupt 2 years ago. Everyone could see that coming. Everyone knew what the impact would be. The housing market has been crashing for the better part of 2 years. The Chinese people, everyday people, even if you have a good job and have some savings, they can't invest in that much. They can't invest in Western stocks because of capital controls. They can only take, I think, $50,000 a year out of the country. There are workarounds and there's money laundering and all that, but basically, it's very difficult for the Chinese to invest in anything except Chinese stocks and Chinese real estate. But they've both been crashing. Chinese real estate's been crashing for a while. It's going to get worse. Now the banks are going to be in distress because they lent all the money to all the properties that are going bankrupt. And then the Chinese stock market has been crashing. It's down over 10%, I think closer to 15% in the past month. So what do you do with your savings? Well, you put it in a bank. These wealth management products are failing. They're kind of like junk bonds. They were sold as equivalent of bank deposits, but they're not bank deposits. They're not guaranteed. They're not protected. The money was used to invest in a lot of these crazy real estate projects that we just talked about. And so they're failing as well. World trade is contracting. That rarely happens, even in a recession. World trade kind of keeps its head above water, but it is contracting, something last seen on a large scale during the Great Depression. The U.S. is putting a lot of technological controls on Chinese exports and not allowing China to import some of the any of the high-tech semiconductor equipment or chips. The Trump tariffs are still in place. Biden made a big deal about undoing everything Trump did. Well, he certainly did that at the U.S. At the Texas border, the southern border of the United States, but he did not remove the Trump tariffs. They're still in place, and you can see Chinese holdings of U.S. Treasury securities are declining. The Treasury has something called the U.S. Treasury has something called the Tick Report. It comes out the monthly, quarterly, I believe it's monthly, but it shows changes in foreign holdings of U.S. Treasury securities, among other things. And China's are declining. So a lot of people, a lot of analysts look at that, particularly Wall Street analysts, And they go, aha, China's dumping the dollar, they're getting out of dollars, they're selling their treasuries, et cetera, et cetera. That's not why they're doing it. They are selling treasuries, but they're selling treasuries not because they want to get out of them. There's a serious global dollar shortage. They're selling treasuries to raise dollars to finance their own banks, which have a lot of dollar denominated loans that are going into default, that where sort of goes from the central bank to the commercial banks to Chinese corporations, state-owned enterprises, et cetera. They're all connected. And it's all controlled by the state. But the reason they're selling their treasuries, and they are, I mean, that's empirically correct, it's not because they want to dump them. It's quite the opposite. They wish they had more, but they need the dollars because there's a dollar shortage and a collateral shortage going on. So that's another sign of acute economic distress. So I look at China. The only way they keep their economy going at all is with infrastructure spending. And I've been to China many times. I've been not just Beijing and Shanghai, but I've been in Wuhan, Xi'an, and Chongqing, and Yangtze River, and a lot of other parts of the country. They do these infrastructure projects that are amazing. I mean, I was in the Nanjing South train station. It had taken, I think, 3 years to build, and it was 20,000 jobs for the whole 3 years. And it's real, it's real steel and copper and marble and glass and electronics and, escalators, and it's all real, but it's empty. I mean, there are 128 escalators, and there's very few people there. And they subsidize the train tickets, so I bought the bullet train. It goes 305 kilometers per hour. I took the bullet train from Shanghai to Nanjing, and I got out the Nanjing train. But the ticket was like $32. I mean, if you take the Excel from New York to Washington, I haven't done it lately, but I don't know. I think it's like a $300 ticket, maybe more, and they lose money. So this bullet train is amazing. I mean, it's much better than anything we have in the United States, not even close. And it's quiet and it's fast and the service is good and all that. But a $30 train ticket doesn't cover the cost. That's obviously heavily subsidized. So my point being, they build these infrastructure projects. They do import the raw materials, or they have the fabrication, manufacturing in China. It does create jobs, and they do get a finished product. That's all true. But they're white elephants. I mean, they will never repay the debt. They will never make money, and they're mostly empty. So how long can you do that before you've bankrupted the country? Well, maybe we'll find out. But I would say China is in very bad shape. Their growth is slowing enormously. Their statistics, I'm sure they overstate the growth. They're not honest about the numbers, but you can take the numbers and do some kind of mental adjustments, or taking what including, for example, under general accepted accounting principles, if you build an infrastructure project and it was worth nothing, the accountants will say, well, fine, you got to write it off. You write it down to zero, keep it on your balance sheet at zero if it's not worth anything. Obviously, they don't do that in national accounting in China. But if you did, their GDP, they'd probably already be in a recession. So that's deflationary, well, at least disinflationary or deflationary. And you look around the world, you see Europe's in a recession. Germany's absolutely in a recession by conventional definitions. Europe has had practically no real growth for 5 years. It goes up and down, a little bit of volatility, but France, Netherlands, now the farmers are taking to the streets, or they're driving their tractors to The Hague and Paris and Berlin, and they're shutting these countries down because none of it makes sense. So how does the U.S. kind of prop up its headline GDP when China's slowing dramatically, Europe's in recession, Eastern Europe's in a war, et cetera? And the answer is fiscal policy. That we're piling, we're spending upwards of $3 trillion a year of deficit spending. Well, monetary policy doesn't work. I mean, monetary policy is kind of a joke, but fiscal policy can work. the question is it sustainable? If you have to spend $3 trillion of deficit spending to get $2 trillion of GDP, and those are about approximately the numbers. How long can you keep that up? And the answer is if you have to look at the debt to GDP ratio. If your debt is going up faster than your GDP, your ratio is getting worse, which, according to a lot of great work by Carmen Reinhart and Ken Rogoff, says that you're going to slow growth even more. And the only way out of that, there are kind of four ways out: default, restructuring, inflation or hyperinflation, and growth. Well, you can forget growth. We don't have the policy set for that, and the debt to GDP ratio is too high. There's no reason for the U.S. to default or restructure, not because we print the money. Argentina has to do it. If Argentina prints pesos and borrows in dollars, they can't print dollars, so they do have to restructure or default on their dollar-denominated debt. But the U.S. debt is dollar-denominated, and we print dollars, so there's no reason to default or restructure. But you will get inflation. And I'm not saying this year. In fact, this year will probably be one of disinflation, maybe deflation. But on a longer term basis, it's the only way out.
Jim, before we leave China, I want to get your views on Taiwan. Mainstream media loves talking about Taiwan and China taking it over. What are your thoughts? Do you think that'll ever happen?
Well, ever's a long time. I don't think it's imminent. There's a lot of talk about it. There's a lot of kind of threats back and forth. Taiwan just had elections. The party that won leans kind of as a pro-independence party, but at the same time, their vote was a little smaller than the last time. So I don't think they are the ruling party for now. They did win the elections, but the support for that view was not was close to evenly divided, not overwhelming. But and China threatens, but China's not in a good position to invade Taiwan. I'm not saying they couldn't do it, but logistically, it's an enormous lift. The U.S. would most likely intervene. Taiwan's getting a lot of new arms sales, preparing to defend itself. I don't want to predict, whether that will happen or not, or what the outcome might be. I think those are highly uncertain things, but I don't see anything imminent. I think it's mostly, a lot of hype at this point. Having said that, there is one key factor that might keep China from attacking, which is what's called the bird nest theory, the bird's nest theory. And the nest theory goes to a Chinese proverb and says, if the nest is broken, how can the eggs be okay? And they'll fall to the ground and crack. So what does that have to do with geopolitics of Taiwan? Well, the answer is that they have the largest, most sophisticated semiconductor industry in the world, particularly Taiwan Semiconductor Manufacturing Corporation, TSMC. They make along with AMD and maybe Intel, they make the smallest chips and fastest chips possible using nanotechnology. And you would not want that technology to fall into the hands of China. So the plan is, if China ever invaded, either we or the Taiwanese would destroy all that semiconductor manufacturing capability. They would get there, but they would just be in ruins. And China knows it. So it's kind of like, well, I like the technology, and there's separate technology import prohibitions in place, but do I really want to see it destroyed? And if I take Taiwan and all that's gone, what's left? Taiwan Semiconductor knows this. Obviously, they're investing, I believe, over $20 billion, maybe more, in building fabs, semiconductor fabrication plants in Arizona. And so they're already looking ahead to the day when maybe Taiwan falls and they want to get as much of their capacity out of Taiwan into the United States. So there are things like that going on behind the scenes that I think that tell you a lot. But I guess the short answer is I'm not ruling anything out in the long run, but in the short run, I don't think China's ready to invade Taiwan.
So we discussed all of these geopolitical events that are happening in the world with Russia, Ukraine, the Middle East, and also China and potentially Taiwan. And when you look at them collectively, they're going to have an impact on the global economy. And I want to get your views on what this time period is like compared to other time periods. And I know you're a real student of the financial markets, but the time that we're living through right now, do you think it's more like the 1920s or the 1970s or the early 2000s?
Well, I guess no two periods are exactly alike, but there is a lot we can learn from financial history and political history. It's kind of a strange combination of I think the 1930s and the 1970s, or at least that's where we're heading. The stock market's hitting new highs every day, and in my view, it's a bubble. A lot of people disagree, and if you said it was a bubble a year ago, but you invested, you made a lot of money last year, so I understand that, but it still looks like a bubble to me. The problem with bubbles is they can go on longer than you think. No one, and you can people say you can't identify a bubble. I disagree. I think bubbles are easy to identify. What's hard is knowing when they're going to pop, and they can go on a lot longer than you think. So you don't want to necessarily run out and short the market. But I'm not. I don't feel like it's a great time to dive in. Um, but we're definitely in a disinflationary trend with the possibility of deflation and a very severe recession. So that's in the cards. But you have these anomalies, or not anomalies, they're just counter trends, and the price of oil is one of them, which we talked about. But that happened in the late 1970s. We had the whole Phillips curve idea that there's a measurable reciprocal relationship or inverse relationship between unemployment and inflation is nonsense. It's just not true. The Fed believes it's true, and so you have to understand it if you want to do Fed forecasting, which I do. But the idea is that low unemployment means higher inflation, and high unemployment means lower inflation. Not true. In the 1970s, unemployment was 11% and inflation was 13%, and interest rates were 20%. So tell me that high unemployment means low inflation. It was the opposite. We had high unemployment and high inflation and high interest rates. It was called stagflation, and it lasted, pretty much for most of the period from 1977 to 1981. And the value of the dollar was cut in half in 5 years. You don't have to go back to 1913 and the creation of the Fed and all that. I mean, I know what those numbers are, but here's a period where the value of the dollar was cut in half in 5 years. So at the same time, money supply is decreasing. Velocity has been decreasing for 20 years and is still at a very low level. So the combination of lower money supply and lower velocity means your nominal GDP is ready to fall off a cliff. I talked to Ben Bernanke about this, and in terms of what was going on in the early 30s, my interest was gold specifically, because the narrative or the rumor or the conventional wisdom, I guess, is that gold was a cause of the Great Depression. The gold standard prevented the Fed from doing what it needed to do, and the sooner you got off the gold standard, the faster you came out of the recession, on and on. But Bernanke made his academic reputation long before he became a central banker, studying the Great Depression. Probably after Milton Friedman and Anna Schwartz, he's maybe the number one scholar of the economics of the Great Depression. And I read his book, and it showed that at the time, this is the early 1930s, the base money supply, so M0, could not be more than 250% of the amount of physical gold that the United States had, valued at the market. The market at the time was $20.67 an ounce. So you took the amount of gold times 20.67, which was the dollar price per gold on the gold standard. Whatever that number was, M0 could not be more than 2.5 times that. But in fact, M0 was never more than 100%. It could have been 250%. It was never more than 100%, meaning that the Fed could have more than doubled the money supply, under the gold standard without breaking the law. And that's how I read it. That's what the number said. And I said to Bernard, I said, Mr. Chairman, I said, here's how I read your work. I said, do I understand this correctly? And he said, yeah. I said, so gold was never a constraint. He goes, no, it was the fact that people didn't want to borrow and the banks didn't want to lend. It was a credit issue. And that's why the money is spicy. But gold was, he doesn't like the gold standard anyway, but for other reasons. But he was very candid about the fact that gold was not the problem in the Great Depression. So we see something like that today, which is M2, which is a different money supply, broader, probably a better, M2 is probably a better reflection of the economy than M0. But M2 is shrinking and velocity is declining. We're not on a gold standard, so you can't blame gold, whether it was true or not. You can't blame gold because we're simply not on a gold standard. So why are we not hitting on those two cylinders? And the answer is the same reasons during the Great Depression. Banks don't want to lend because they're worried about recession, and people don't want to borrow because they're worried about bubbles or declining commercial real estate values, and they just want to hoard cash. So that's very much of a depression dynamic. But at the same time, we have this this spike in oil prices, and that could get worse. So it's a mixed bag. But I think I've said in my books that the U.S. economy has been in a depression since 2007, and then people don't understand that. They go, well, the definition of a recession is 2 consecutive quarters of declining GDP. There's a little more to it than that, but that's the rule of thumb. So 2 consecutive quarters of declining GDP, 2 or more, is a recession. A depression is worse. So a depression must be like 10 quarters of declining GDP or something like that, which of course has not happened. But that's not the definition. The definition of a depression, I take this from John Maynard Keynes, is a sustained period of below trend growth with no tendency to return to trend. In other words, it's depressed growth. You can have growth in a depression. It's just below potential. If your potential is 3.25%, 3.5%, and your actual is 2%, that gap between the 3% and the 2%, which gets wider over time, is depressed growth. And by that measure, yes, we have been in a depression since 2007, and the lost wealth is now, order of magnitude is kind of $5 or $6 trillion, but getting bigger all the time. So I think we're in a depression using that definition. It's good enough for Keynes. It's good enough for me. And with no way out of it, and possibly getting worse. So I would say the U.S. will likely experience a very severe recession, may already be in one. Then the question is, do you get a banking panic on top of that? Because banking panics or financial panics in capital markets or banks are not the same as recessions. They're different things. You can have a recession without a banking panic, as we did in 1990. You can have a financial panic without a recession, as we did in 1998. 2008, we had both.